Good morning and good afternoon, everybody. We'll be starting the presentation shortly. Waiting for a good chunk of people to sign in and participate. Everybody, thank you for joining us on our presentation today. At C.O.R.E Group, as you know, we offer one of our areas of expertise is business planning, business succession planning, business transition planning, and exit strategies for business owners. One of the least talked about options in the marketplace is ESOPs. And the great thing about an ESOP is it covers all three of those issues, does it on an extremely tax efficient basis. It's the most tax efficient way that a business owner can transition out of their business, keep more of the proceeds from the sale of the business for themselves, provide incentives for key people to stay with the business, and provide incentives for the employees to be more productive for the business. An ESOP really is a fantastic tool for the right client, the right circumstances. Today, Roy Farmer with Business Transition Advisors is going to do a presentation. We partner with BTA when it comes to ESOPs. ESOPs are a highly specialized transaction or solution, and it requires a great deal of expertise. Roy has over 40 years expertise in the ESOP marketplace. I don't know anyone in the business that with more experience or more able to explain it in plain, clean English that everybody can understand. If after the call today you have cases and opportunities you'd like to discuss, we'll provide you contact information afterwards. Roy, I'm going to bring up the presentation.
Thank you. Okay. So I guess that's my cue.
Yep, Roy, if you wouldn't mind taking over and enlightening us with regards to the ESOP plans and business transition advisors.
Good, thank you. Well, let me just say thank you all for being on the call. We're going to do our very best to make it worth your while. But as Rob has mentioned, we work in the business transition, business exit planning space. BTA is a company that I founded with my partner about 15 years ago. And before that, I was a business owner in California. I owned a company that was in the San Francisco Bay Area. I grew that to about 250 employees, and we needed a way to anchor our engineers to our company. I don't know how many of you know about engineers, but they're really hard to come by, especially good ones. And when you get them, if they're really good, your competitors want to try to poach them away from you. And as that was occurring to us, we met with our law firm, who was in Oakland at the time, and they said, "You should do an ESOP." And this is, 35 years ago, I guess. And so we did an ESOP. It worked out really well. It did exactly what was advertised. It anchored our employees kind of with golden handcuffs, as we all call them, to the company, and it worked out really well. Ultimately, that company was acquired by a public company, and I don't know whatever happened after all of that. It's been so many years now, but it was a great tool that helped us build the business and keep our clients and our customers satisfied that we had the right people in the right spots that were willing to stay and make a commitment to the company. Now, recently, BTA, I was a co-managing director with my partner Fred, and I'm getting, like a lot of your clients, I'm getting older, and so 18 months ago, my partner and I sold 100% of our stock to our newly created BTA ESOP. So the one thing that you're going to find with us, there are a couple of other companies out there that do ESOPs, but we're one of the only companies that do just strictly ESOP planning, and we have an ESOP ourselves. So you can tell that we believe in it. This is my second time, but BTA is a national company. Let me go through that with you as we go through the slides. Next slide. Okay, so here's the value proposition, and then we'll talk a little bit more about BTA. What if you were able to sell all or a portion of your company to a ready and willing buyer at full fair market value? Indefinitely defer all capital gains taxes and leave behind a completely tax-exempt company to the next generation. The obvious question is, would you be interested? And almost every client that I present this to says, well, Roy, if you could do all four of those things, I'd be just incredibly happy. But if you could only do even two or three of those things, I'd be really happy. Now, as Rob pointed out, an ESOP isn't going to fit in every circumstance. It's not going to fit for every company, but where it does fit, it can be amazing. And we can actually accomplish all four of those things for the client. Most of the time, we get at least three of them, and sometimes we actually get all four. And there are some other things that we can do in addition to the ESOP from the estate planning side, and some other things that could actually add to that list and make it very attractive. But that's what's achievable. Next slide, please. So we provide service in all 50 states. We now have offices in 10 states with employees there, from the East Coast out to the West and down to Texas, and up to Montana and Denver. We have an office in Denver. So we kind of cover the country. We've worked with companies with over $5 billion in total values, and we've done about some number over 500. I quit counting at 500. I think we're 525 or 530 right now. And the thing that I'm most proud about is that and I'm knocking on wood, is we've never had a client ever lose a DOL or IRS audit. Now, as you know, and you'll soon learn, ESOPs are an ERISA qualified plan. And ERISA is regulated by both the Department of Labor and the IRS. So our clients are audited occasionally, but we've never had an occasion where our client lost any economic benefit or had to pay anything to the IRS or the Department of Labor. And that's a record we're really proud of. So that's why we work only on referral, and we work with I'm not going to give you the whole list, but we've been approved by Morgan Stanley and by JP Morgan Chase. We're approved by most of the major banks like Wells Fargo, B of A, and many of the regional and smaller banks. Most of the large insurance companies, Pac Life, Penn Mutual, AXA, John Hancock. I mean, I could keep going. And then a lot of individual planning firms like the C.O.R.E Group, as well as accounting firms and law firms across the country. So we've got I think we've done probably some, we're one of the firms that have done the most E.S.O.Ps, I think, out there. And we service the whole country. So wherever you are, there'll be somebody not far from you who could help you if you need help with a client. Next slide. So E.S.O.Ps, and I think it's important to get the good, the bad, and the ugly. E.S.O.Ps are not perfect. One of the considerations and concerns about E.S.O.Ps is they are very, very technically difficult. I mean, you have to have somebody who knows what they're doing. And the problem is, unlike, if you want to do some insurance planning, you have to find a guy who knows insurance. If you want to do estate planning, you got to have an estate planner. And this is no different. I mean, this is a very specialized area. It requires you to follow the law absolutely and do it every time. And obviously, without us never having an IRS or DOL negative outcome, we obviously know how to do it. But it is technically difficult. And all of these things have to be done. They may look simple, and some of them are not terribly complicated, but some of them really are. And some of these bullet points have 10 or 15 sub bullet points of things that need to be done. Now, that's what we do. That's our job, is to make sure that you and your client are satisfied and you're taken care of, and the E.S.O.P is put into place correctly, and we're not going to have any downstream problems with any IRS or DOL issues. That's what we try to do. But you do have to understand, and Rob said it, they're technically difficult. And I think we do a very good job of unwinding the difficulty and making it simple to understand for most business owners. And we'll talk about that in a minute. Next slide. So we use a team approach. Most of the time, our clients will have a CPA. They may or may not have corporate counsel. I had a call with a new client yesterday, and he says, "Well, we have an attorney that will do things for us, but we don't really have a corporate attorney." Well, you'll need a corporate attorney because they're on the team to get this done. We do about half of these things that need to be done, and these other, like estate planning, we don't do the estate planning. But if your client has an estate planner and that estate planner says we need this outcome, we can structure the transaction to get that outcome. But we're not going to do the estate planning for the client. And by the way, how we're paid is just like any other consultant or attorney or accountant. We get actually a flat fee to do the transaction, which varies with the size and the complexity of the transaction. But we don't take any commissions. We don't sell any products. That is completely left to you guys and your relationship with your client. But we make sure these things all get done. We stand as the quarterback. We make sure that everybody is satisfied and everything gets done on time and on budget. Next slide. Now, in E.S.O.P, the acronym E.S.O.P stands for Employee Stock Ownership Plan. It is a tax-qualified defined contribution employee retirement plan. It is overseen by the IRS and the Department of Labor, and it is a qualified plan under Section 401A and 4975E7. Now, we don't need to get tangled up in the tax code, but you do have to follow the rules and make sure you follow these regulations, of which this is where we spend our life. So we understand all of this, and that's why we've done so many of these E.S.O.Ps. It does, at the end of the day, allow employees to become beneficial owners of stock in the company. And that's one of the goals that many of our owners want to achieve, if not all of them. But those things are kind of the background. And I get a lot of people who say, well, this is all good information, but I've been in the business 30 years and I've never heard anything about this. Well, E.S.O.Ps, as Rob pointed out, they require a lot of different disciplines: ERISA law, corporate law, tax law. It requires business operations, cash flow projections, valuation. I mean, there's a lot of different things, as you saw in that earlier list. And that's one of the reasons why some people just say, unless you know somebody who can really help you, it's very difficult to get involved in this on your own. Next slide. So there are many tax features, but there are three primary tax features, and these are in the black and white tax code. And what I mean by that is we don't need a legal opinion from a law firm or a big accounting firm to tell us how these things work and if they're able to be done under the code. We've done these on almost some variation of all of these and over 500 transactions and have never had any of these things ever questioned by the IRS or anybody else. So the first one is, which can be a big deal depending on your client, depending on the circumstances. If we set up a qualified ESOP and the owner sells his or her stock to the ESOP, they can initially defer and ultimately avoid the capital gains tax. Now, again, in a state like California or any of the high tax states, New Jersey or Illinois, or, there's a bunch of them out there, some owners can give 30, 35% of what they've accumulated in their business over their lifetime back to the government. And if you can show them a way where they can legally avoid the capital gains taxes, most of the time that's a very easy discussion to have with an owner. And by the way, many of them don't know that it's even possible to do that. Two, the company can receive a dollar for dollar deduction for every dollar's worth of stock sold to an ESOP. So if we have a company that's worth $20 million or $50 million or $80 million, we get a dollar for dollar deduction. So that if it's a $50 million company, we're going to get a $50 million tax deduction for the company. And that occurs in every single transaction. Three, this one doesn't always occur in every transaction, but it's very common. There are about 4,000 ESOP companies out there that pay no state or federal income tax. It's the only way that you can be tax exempt without being a 501c3. This is being a 100% ESOP owned company. And so if the owners qualify, and if this is something they want to do, we can show them how to become state and federal income tax-free, tax exempt, however you want to actually couch it to them. But those are the three primary benefits that we focus on in ESOPs. And again, most owners are not even aware that any of these things are, or maybe only one of them is even achievable. And that's one of the reasons that we have a lot of interest in these presentations, is to learn how it's possible to do those things. Next slide. Now, ESOPs are used for many different reasons. We tend to use them for the first three bullet points: business owner exit strategy, next gen transfer, diversification of their closely held stock, and to buy out partners. Now, these other three in the bottom, they come up. We don't see those really all that often. Sometimes the desire for employee-owned culture can drive the whole transaction, but also can a divorce or some other immediate cash need, or maybe the desire for enhanced employee benefits is driving the owner's concern. We don't really ever know until we get a chance to meet and talk to the owners. Next slide. Now, most owners have concerns. When they transition, they want to make sure the company is not going to fail immediately upon them leaving, and they're frightened if they turn it over to their employees. The employees may not know how to run the company. Well, the 500 transactions, actually more now, that we have done, I've had two that have failed. One was during the 07, 08, 09 financial crisis. It was a construction company in Florida, and their revenues the year in 2006 was 150 million. In 2007, it went down to 75 million. And in 2008, they were doing 25, not even enough to. So it matter not, which is also one of the misconceptions about ESOPs. The ESOPs don't make a good company bad or a bad good, but they can make a good company better. And they have a high rate of success if they're done and put together correctly. But these owners are interested in minimizing personal and corporate taxes. Most of them tell me when I meet with them, and I've met with hundreds of business owners over my career, that, hey, look, I give enough to the government. I've collected and paid millions of dollars in taxes over my lifetime, and I'm ready to not do that anymore. They want to leave the corporation with proper working capital and manageable, if any, debt. What happens is the company cash flow usually is enhanced by 25 to 35% because they're no longer paying those taxes to the government, and that makes the company ultimately more successful. And if the much greater. Many of these owners want asset liquidity and diversification. The studies by owners that have medium-sized to smaller businesses, and I'm talking now in that $5 to $20, $25 million range, most of their assets are in the company. Now, when they get bigger companies and they're in 30 to say $100 million, the company's creating enough cash flow that they've probably been able to diversify, at least to some degree, but they still need liquidity. They've worked hard, they built the business, they now want to get paid for all the work that they've done. Most of them want to convert the business to retirement income. If I'm not going to work anymore and I'm not going to be in the business, how am I going to be able to pay all of my bills and achieve the goals I have in retirement? Well, the answer is we got to convert the income of the business, the value of the business, to retirement income, and ESOPs are very tax efficient at doing that. And many people want to preserve the family and community legacy. And of course, they want fair market value for the company. Next slide. Now, there are options, and all traditional sale methods use after-tax dollars. And there are a ton of those methods of how you'd buy a company and how you can structure it, but somebody's going to be using after-tax dollars. The ESOPs utilize all pre-tax dollars, which makes the tax savings so powerful. Let's show you an example in the next slide. Now, we just actually made this value up because our average client is $20 to $50 million in company value, but we do a lot of companies in the $8, $9, $10 million range or above. And this just gives you an idea of what the tax consequences are to an owner selling their company. And most owners, it's amazing to me, but most of them don't even know what their tax situation is when they go to sell the company. They usually get their accountant to figure out what it is once they've entered into an agreement. But if you're doing a management buyout or a corporate redemption, rather than just selling it on the outside, a $20 million valued company is really requiring $27 million of earnings to buy the company. So if you were going to have your management take over and they weren't going to use an ESOP, excuse me, and they were just going to go ahead and let the company earnings pay for the business, they'd have to earn $27 million, which obviously isn't going to happen quickly. And then they're going to end up using the tax numbers I have noted at the bottom, which are kind of average across America tax numbers. The owner would pay about $7 million in corporate tax, and he would net $20 million, which is what he wants for his company. And then he's going to have to pay in some states, there'll be a lot more, but average across the country is 29.2 combined capital gains rate, 5.8 million in capital gains tax, and he's going to net $14 million. And in the transaction, to get his liquidity, he would have paid almost $13 million. Now, again, I don't know where you're all listening from. Some of your states, that number is going to be way higher. Some states, it'll be lower, but it's still, no matter whether it's lower or higher, it's a lot of money. And when owners see that calculation, most of them take note, and that's when they really start to have a tax discussion with their CPA. And of course, we would do specific analysis for a client and show them what their situation would mean, and they can see their own individual number. In an E.S.O.P, if we're using an E.S.O.P instead of using just a management buyout or some version of a corporate redemption, we would have $20 million would be required because that's what the owner wants for the business. And we get a $20 million deduction legally from the government, and we would pay zero corporate tax. Now, if the stars align and the owner has a difficult capital gains problem, we can show them how to completely avoid paying capital gains tax and end up with $20 million and having no taxes paid. Now, the obvious question to a client is, all right, which one of these two scenarios do you want? And we all know it's going to be the lower taxed one. Thanks. Next slide. Now, how does this work? And again, it takes some explanation, but basically the company would initially has a board of directors. I think every company, every state has a requirement that they do. Sometimes it's a one-person board, sometimes it's a three-person board, or they can have 5 or 7, but they're going to have a board of directors. The board of directors would have to agree to adopt the E.S.O.P, just like they were adopting a 401k, but it's a different type of a vehicle. So once they adopt the E.S.O.P and we have a vote of the board of directors, it has to be a majority vote, and they have to have a set of minutes, and they have to have a corporate resolution to set up the E.S.O.P. Then the E.S.O.P starts to exist, and we would help them design the E.S.O.P and work with them to make sure we get it designed within their goals and objectives as much as we possibly can within the law. And so every transaction that we do is different. They all have some similarities, but there's no cookie cutters. There's no one size fits all, because if you do that, you leave a lot of benefits on the table that the client wouldn't normally even know that they could ask for. Next slide. Once the E.S.O.P exists, we have to get money to fund the transaction. So most of the time, our companies have a banking relationship. Some of our bigger companies have 3 or 4 banks that they borrow money from. And if that's the case, we're probably going to find at least one bank that would be willing to loan the money to do the transaction. And the banks are in the business of loaning money. They don't make anything unless they do. So the lender will lend the money to the company, and then the company will take that same amount of money and loan it to the E.S.O.P trust, thereby funding the trust. And we have 28 major banking relationships around the country. A lot of banks will do these loans that a lot of people don't even know they will do them, but they will. And we can help in that. And we're committed to find the financing for the client if the client doesn't want to do that themselves. That just means that they're going to end up paying us to do something that perhaps they could do if they wanted to, but it would be up to them. Now that we have the trust funded, next slide, please. We have to select an E.S.O.P trustee, and we recommend a number of E.S.O.P trustees. We have them located around the country. They tend to work in specific industries like construction or manufacturing or maybe oil and gas. We have one guy that works in oil and gas. And so we have them spread throughout the country. We recommend the best trustee we can. The board of directors hires the trustee, and the trustee is there to act as the buyer of the stock on behalf of the employees. So even though at this point, in every E.S.O.P discussion that we have, the employees will know nothing about this. There'll have been no announcement, there'll have been, no indication that this is even going on, but behind the scenes, this is all happening, and the owner is fully involved and understands it all and is impactful as to what we do. Some owners will want to do one thing, others will want to do another thing. I've had some owners talk to senior management and let them know this is happening, but rank and file never. And it would be a bad idea to do that. So now that the ESOP is formed, we have a trustee, they're ready to enter into a transaction. So our job as BTA is to represent the selling shareholder. And we enter into negotiations with the trustee. And just so you all understand, one of our core competencies is valuation. We have 4 people that have anywhere from 10 to 40 years experience in valuation. 2 of them are CFAs, if you know what a chartered financial analyst is. One in our Richmond office in Virginia and one in our Denver office. And these guys they live and breathe valuation. And we tend to get very, very robust valuations because these guys understand all the driver. We have clients that want to hire us just to do valuation consulting to show them how to get the value of their company higher. And we will do that in the course of our transaction. But once we have the ESOP trustee in place, we start negotiations. The owner's involved every step of the way. There's an offer. Starts with an offer from the seller, and it goes in the trustee. The trustee will hire her own team. He will have a evaluator on it and an ERISA attorney that represent the trustee, and they will negotiate on behalf of the trust and the employees, and we negotiate on behalf of the owners. Ultimately, a transaction is going to be done, assuming all parties are acting in good faith, and the people we bring in and work with will. And the money will come down to the selling shareholders that came originally from the bank, and the stock will go up to the ESOP trust. Now, if we want to do 100%, no bank in America is going to loan 100% on any company. If you've got a company worth $10 million or $500 million, they're not going to loan that much money, the 100% of it to you. So this may be a partial stock sale, or if we want to be tax-free, it could be a full 100% stock sale. And instead of confusing everybody with a bunch of more arrows and boxes, there would be a seller note involved if we were going to sell more than what the bank would be willing to loan. Now, after the shareholders get this money, if they want to be tax-free and pay no state or federal capital gains tax, the company has to be a C Corp on the day of the stock sale. Doesn't have to be a C a week ahead of time or 2 days ahead of time, but on the day that stock sale occurs and the date on the stock purchase agreement, that's when you have to be a C Corp. Now, if a company is an S Corp, we can show them how to revoke the S and become a C. Sometimes that's a very good idea. Other times it's better off if they remain an S Corp. It just depends on what their tax liability is and what their circumstances and their individual goals are. But the way you avoid the capital gains tax is under Section 1042 of the code, and I'll explain that in just another minute. Next slide. Now, after all of this has gone on and there's been a stock sale, the bank wants their money back, right? I mean, every bank isn't going to make a loan unless they have a reasonable expectation that they're going to get their money back. So every year out of the profits of the company that is being earned every year, the company is going to make a cash contribution to the ESOP trust. This contribution is very similar to a 401k contribution. It has to meet certain guidelines, and we're going to make sure all the guidelines are met. If you over contribute, there's a penalty and there's money to pay to the government. But as long as you stay within your 404 and 415 C2 limitations, the cash that goes from the company to the ESOP in a contribution is booked on the income statement as an employee benefit expense, and it's fully deductible in the year that the contribution is made. And that money goes to the ESOP with that black or brown dotted line. And the ESOP receipts the money and then says, thanks for the cash payment. Now that I have money, I have this original loan that I got from the company when we first started off, and now I need to make a payment. So they take that cash contribution, turn it right around, make a payment to the company, and then the company makes the payment to the bank. So everybody's happy. The bank gets their money back as they agreed, as they made the loan commitment to the company. And the company got a large tax deduction because that contribution is completely deductible, and everybody gets what they want out of the transaction to this point. Now, this loan up here on the top, I'm not going to take a lot of time, but that loan is actually in the tax code called an exempt loan, the loan between the company and the ESOP trust. Now, you might ask, what's it exempt from? Well, it's the only loan in the tax code where you can deduct also the principal and interest on that loan. So you can look at it in two different ways. One, like a 401k contribution, fully tax deductible, or you can look at it from an exempt loan perspective, and the company gets to deduct both the principal and the interest on the loan. Only place in the tax code that that's possible is with an ESOP. Next slide, please. Now, the employees are really, at the end of the day, the reason that we're doing this. Of course, no owner's going to do it unless they are enriched and get the value for their company. We wouldn't expect that they would. I wouldn't do that. When I sold my shares to my ESOP at BT, partner and I took some cash, and we took a note, and we're being paid over time. And we have an extraordinary level of confidence in our employees and in the company. And we want our employees to be beneficial owners. Now, I'm not going to get again tied up in all the tax code, but it's a beneficial ownership, not a direct ownership. The employees will not get a stock certificate with their name on it. They are going to get a statement that shows what they own each year that will come once a year. And depending on the company and how large it is and how many employees, some of them will actually have an interactive website where they can see the value of their investment every single day. Not that it's even valued every day, but that's possible if some companies want to do that. But the reason the beneficial ownership is there is just like the 401k. If they own the stock directly, it's taxable. It's called constructive receipt. And so we make sure that they're denied constructive receipt intentionally, and therefore the employees pay nothing until a later date. Next slide. Now, eventually, these employees will hit what's known as the 5 triggers of ERISA: death, disability, retirement, termination, or diversification. That's how employees get liquidity and get money out of the ESOP. So some owners look at this in a way as a kind of a forced retirement plan. I have never, I've probably been involved personally in over 200 ESOP transactions just myself. And I've never recommended nor never included in a plan document a loan provision within an ESOP. It's problematic. I'm not going to bore you with all the details, but we just don't do that. So the way an employee gets their money, every year they work for the company, they get additional beneficial interest. Their stock starts to grow. Hopefully the price of the stock is growing. And when they hit one of these 5 triggers, they have the right to a distribution. Now, obviously, death and disability are pretty straightforward, as is retirement. Termination can be voluntary or involuntary. One of the things about ESOPs that people misunderstand is, oh, now that I work for an ESOP company, I have a guaranteed job. No, your job is just like it was before. You're an at-will employee. You don't do your job, you're going to get terminated. Or if you don't like the company, you can quit and go somewhere else. And at that point, there would be a distribution that's made based on the plan document, and diversification is under Kennedy Feingold. And after you are in the ESOP plan for 10 years, and you have 10 years of distributions, then you have a right to, when you obtain age 60 or 55, excuse me, you can get a 25% distribution from the ESOP, which you can then roll into your 401k if you want. Or when you're age 60, you can get 50% and roll that 50% into your 401k. Now, the reality is that's the law. The issue is that most employees don't do it. The ESOP companies generally do very, very well, and they realize that in many cases doing much better than the broad stock market. And they know the owners, they trust the owners, they must like the owners or they wouldn't work there. And so they just don't usually take advantage of the diversification, but that is in the law. We do a 20-year actuarial study that forecasts what the liability is based on the age of the employees and other factors, and give that study to the company, to the CFO, and to the owner, and show them that over the time they need to build up a sinking fund to be able to provide for that liability that's coming down the pike. It's called the emerging repurchase liability. Now that's how ESOPs work. I go over a little higher level with individual clients. I went into some detail with all of you because I think you want to know that. But one thing you probably don't understand is what the benefits to all of you are as a result of this transaction. So the first thing is, in many cases, depending on again, whether we have one owner, two owners, three owners, we never know till we get a client, but most of the time, if an owner wants to retire, they want to make sure that if they die and their wife is left to collect any note that they're owed, that note is as much guaranteed as it can be. And that means there's a nice life insurance sale there. And the bank is not going to make a loan of over $5 million to any company without the owners having key man insurance. So the first sale can be a key man insurance, either to secure the note or to make sure the bank is paid off. Either way, that kind of secures the note. And that's one nice sale that occurs. Also, the inescapable result of an ESOP is liquidity. So your owner is going to get a lot of money. So he's going to get some of it up front, and then he's going to get some every year and get a big lump sum. And over a 5 to a 10-year period, he's going to get the value of that company plus some additional interest and other benefits. And that money's going to come out, and somebody's going to manage that money. And we don't do any of that, as we mentioned earlier. So all of you who manage money, this is a way to get large blocks of liquidity that come into your book to manage from owners that are exiting their business. And what we find is if you're involved in helping them exit and you're the one who brings this idea to them, you're going to get the money. If you let them go to some M&A broker outside, chances are that M&A broker already has a relationship with some other financial advisor or may have their own financial advisor in their firm, and they're likely to get that money instead of most of you. So this is in your best interest. In addition, many of our smaller companies, I would say the 10 to the $30 million ones, they haven't done all of their estate planning. Some of them have done none of it. And this is a perfect opportunity, and you're going to see in a minute how the estate planning can work. But it's a perfect opportunity, and some of our largest sales are estate planning sales that come as a result of the client doing the estate planning. And now that they have the liquidity and the money and the cash flow, they can afford to pay insurance premiums where previously maybe they weren't able to do that or didn't see the value in it. The other thing, and the very largest sale, is this sinking fund. That's normally funded with corporate-owned life insurance. It can be funded with a combination of securities and investments, but corporate-owned life insurance is almost always involved. And in some companies, they want a guarantee, and the insurance company provides that. So that is a highly desirable asset for that sinking fund. And some of the largest sales that we've seen have come out of that. And we've had sales where the commissions are, 5 million plus on just this element alone, depending on, obviously, it's a big company. You can't do a $5 million sale with a $20 million company. But if you get an 80 or 100 or a $200 million company, and by the way, we've done transactions up to $750 million, you can get some very large commissions as a result of that. Next slide. Now, the 1042 is the way to avoid the capital gains tax, and it allows the shareholder to indefinitely defer the capital gains tax on the sale proceeds, regardless of their basis. similar to a 1031 and a 1035, and they must invest the proceeds in qualified replacement property, U.S. stocks and bonds. So those of you who are managing money, this is a great account to have. The client, if they ever breach that account, they have to pay the tax. As long as they maintain the exchange, just like a 1031 or a 1035, the tax is deferred. When they die, they get a stepped up basis and the taxes go away. But if you're managing money, this is a great way to do it. And there are special E.S.O.P vehicles with floating rate notes that allow the owners, the sellers, to get guarantees as well as have the capital gains deferral. Next slide. Now, 100% S-Corp E.S.O.P is really the state of the art today. We all know that now with Donald Trump in the White House, federal taxes seem to be moderating, and hopefully they will. And it'll stay in place now that it's permanent, I guess, unless they repeal it somewhere down the line. But states are in many cases are hungry for revenue, and they're increasing their. So if you get subject to federal corporate income tax, that can be a big deal. The taxation is passed through to shareholders in proportion to their ownership, and because the E.S.O.P is tax exempt, therefore no tax is paid on the percentage owned by the E.S.O.P, and the corporation does not have to distribute the income. Next slide. Picture's worth 1,000 words. So today, if you have an S-Corp company or a company that is an S-Corp, chances are your CPA prepares your Form K-1. Under the tax code, the K-1 is required to go to the shareholder. Now, I'm making this simple and showing one shareholder. There could be 5 or 10, or I think the most we've ever done is 22, but let's keep it simple with just one. That shareholder gets the K-1. They're required under current tax code to file a 1040, and they have to pay their tax. Now, most owners are familiar with this, and they say, yeah, I understand this, but here's how it works with an E.S.O.P. Next slide. So after the sale, the CPA is needed more than ever. The CPA continues to prepare the Form K-1. The K-1 goes to the owner, but the owner now, since we sold all of the owner's stock to the E.S.O.P, is the E.S.O.P, which is represented by the trustee. That E.S.O.P shareholder gets the K-1, does not file a 1040, files a 5500 because the E.S.O.P is tax exempt and they pay no state or federal income tax. That's how you become tax-free. And by the way, think about that just take your contractor clients. And we've done, I don't know, 300 contractor clients probably, or 250. Think about it. Let's assume that 3 of us are bidding, and I'm an E.S.O.P and I pay no state or federal income tax. And I want that big, nice new jail courthouse down in the city center that's being built. That's a $50 million project. And my 2 competitors that are also qualified bidders are paying state and federal tax. If you really want that job, you can get it because you can bid it at a low price, a price lower than they would never be able to do it because they would lose money, and you could still make money because you're not paying any state or federal income tax. It increases the competitive incredibly. I don't know how many of you know there are a lot of grocery stores that are E.S.O.Ps. Back in the Southeast, we have Publix. Out in the Midwest, you have Highview. Out in Idaho and in the West Coast, you have Winco Foods. I'm familiar with Winco. There's one of them not far from where I live. And Winco's been an E.S.O.P for 40 years. And their claim to fame is they pay their employees more per hour than Walmart. They sell their products cheaper generally than Walmart does, and they make a higher net margin. So that's the power of what can happen. And it gives the company a much greater staying power. And if times get tough, it's really easy to see how those companies survive while others may not. Next slide. Now, this is just a quick example but I think this is simple but great. This is a $20 million company, and typically on a $20 million company, that's just a standard kind of everyday company. 4 million of taxable income times 5, a multiple of 5 would get you to $20 million. Over a 15-year period, the company would earn $60 million, but because of the current tax situation, they would pay $25,200,000 in tax, and they would net $20,800,000. We did the E.S.O.P on exactly the same company with the same dynamics, and the company doesn't grow, it doesn't shrink, it just chugs along. They're going to have the same 4 million a year, the same 60 million over 15 years, but they will pay 0 state or federal income tax. And their net cash flow after tax will be 60 million, which meant they saved $25,200,000. Now, here's an easy, simple 1-minute way to present an E.S.O.P. Mr. Client, what if there was a way that you could legally keep the tax money that you're now sending off to the government, keep it in the company, and use the government's money to buy you and your family out of the business? And then once that's done, I've said in a lot of these details early on, but what essentially you're doing is using the government's money that you're now positioning yourself legally within the tax code to keep that money, not send it to the government. And we instead turn right around and give that money to the owners and their family, buy their interest in the company out. When they're fully bought out, then the company is literally owned by the employees. That's E.S.O.Ps. Next slide. Okay, there are a lot of qualitative benefits. I don't want to go through each one of these for the interest of time. I'm personally familiar with golden handcuffs and reduced turnover, and I have other clients that have seen reductions in all of these other benefits, like worker comp claims, which can be a really big deal because it's real expensive these days. But those qualitative benefits, you generally can't put a dollar figure on, but some of them can be extremely valuable to the right company. Next slide. Okay, so now we got to finance this sale. There are 3 possibilities: bank financing, seller financing, or a combination of bank and seller financing. And normally that third bullet point is the one that we generally end up using. Now, next slide. Looks like we've got something going on. There we are. Okay. So today, with the current lending environment the way that it is, and we think interest rates will go down between now and the end of the year, is the senior debt is the cheapest money we'll ever get, even though people say rates are high right now. And sure, we're all spoiled. When you can get a 3% mortgage, you get a 7% mortgage. I think little, but banks will generally loan a company 3 times EBITDA. And that's earnings before interest, taxes, depreciation, and amortization. That means they're going to loan you 50% of the equity of the company. Now, if you want to be 100%, so you can be tax-free, we need the seller. No, this is like a private equity firm, or they call it mezzanine financing, that today it's expensive. It's 10 to 12%. And they'll loan you pretty much whatever you want. They're going to be behind the lender, getting a pre-money. And most of these can't afford to pay it. So here's kind of how we look at it. Next slide. Bank. Nobody wants a company cash flow to suffer. And if you're required to pay 6 to 8%, that's reasonable. But if you're going to pay more than that, it gets to be difficult. And you're going to have a hefty ordinary income tax for the seller. So in lieu of the market rate of interest, the seller will take a lower interest rate, and we structure a substantial future equity stake, somewhere between 20 and 30%. Next slide. This slide shows you how that works. If you look at that, it looks very similar to the last slide with the exception of this stuff up here on the left. So let's assume that the seller says, well, I'll take 5%. I don't need any more than that. And by the way, if you have a $10 million note, it's $500,000 a year in interest, probably with what the owner's making in salary, probably more than he's making now in total. And if it's a 20 or a $30 million note, it's 10, $15 million a year in interest, even at 5%. And then you got less income tax, of course. But what one of our evaluators do is we say the IRS's position is that you're entitled to a market rate of interest. So the market rate of interest is 10 to 12, but the owner's going to accept less. So what we do is we value that foregone income stream over the term of the note, and we convert it into a warrant. Now let's go to the next slide. A warrant is the right to purchase company stock at a future date at a fixed price. The exercise price is post-transaction stock value. It gives the seller a second bite of the apple, and the warrant will be given or gifted to management members and gift tax. Just an example of a company. I think it was one that we did, but we changed some of the numbers just to make sure confidentiality, but this is pretty typical. $20 million company, the owner got an $8 million cash down payment. So for those of you who manage money, I don't know what they're going to do with the 8 million. Most of them spend a little bit of it, kind of like a reward for all the hard work of owning the business those many years. So they might buy a new car or a boat or an airplane or something, but usually they have plenty of money left to invest. You got a seller note of $12 million at 4.5% interest. They would collect an additional 4.5 million of interest over the term of the note. And then the warrants, just being very conservative, would be worth $6.5 million. So the total proceeds are $30 million over on a $20 million company over the term of the sale. Next slide. Now, what was the outcome that we've been able to deliver to the client? Well, we got them fair market value for the stock. We're always going to do that. He may have received some cash. I've got one client right now that's got $35 million on the balance sheet. They're going to get the cash on the balance sheet and a bank loan. So they're going to collect, it's about a $150 million company, and they're going to collect probably 65 to 70 million in cash up front. Then we got them long-term interest income on the seller note. We deferred and avoided the capital gains tax on the sale. The warrants component comes into 20 to 30% of the future value of the company. So the owner's still interested in maintaining some interest and relationship with the company, because over time, these warrants on a big company can be worth tens of millions of dollars. Then there are some estate planning and gift transfer benefits, and the company's profits became tax-free. Next slide, and I see we're almost out of time. So I'm going to go over this really quickly, but for those of you who have large clients that have estate tax problems, an E.S.O.P is one way to solve a part of the problem. So the equity stake in the warrants is worth almost nothing. It's actually worth what's known as an OID value at the time of issuance. And so an owner can take those and put them in a family trust or a family limited partnership for children, grandchildren, yada, yada, all the above. We can transfer those to the next generations with little or no gift tax or estate tax or using any of their lifetime exemption. The seller's subordinated note is subject to significant discounting because it's behind a senior lender in the term of an independent bank. And for discounting and estate tax purposes, we can get about a 40% discount on that. And then if we use a CRT or an IDIT, we can wrap that around the note. And we've done that a number of times. And you can get the estate value for the note almost down to nothing. So ladies and gentlemen, that's E.S.O.Ps. I'm sure you have questions. I'd be happy to answer them. You're welcome to have my phone number. If a client wants to go forward, we do what's called a preliminary analysis. It costs, that's a cost item, but then we do all of this stuff and do a presentation. We value the company. We tell them what we think we can get for the company, look at their debt capacity to make sure they can get financing, look at their cash flow, because if it won't cash flow, it's just not going to work. The tax savings, most of the time, we're going to save. Taxes are going to be almost equal to the value of the company in terms of the savings. And sometimes it's a little more, sometimes a little less, but pretty much if you've got a $50 million company, we're probably going to save your client about $50 million. Objectives, that's important. And we look at that and make sure the cost we've expanded this. It's now a $15,000 cost item. I guess that's the old slide, but it can be a little more, but generally it's not. And for a small company, we could still go for $10,000. So with that, Rob, I'm going to hand it back to you and take it from where you want to go.
Thank you, Roy. Appreciate the presentation. There was one question from John Sullivan. When does he or she ultimately pay capital gains tax on the sale? They can actually defer it through the 1042 exchange. And if they die before taking assets out of any of the assets in the 1042 exchange are going to get a step up in basis at death. So theoretically, they could defer the capital gains indefinitely.
Yes, it's most of our clients, the ones that are interested in the capital gains deferral, we design a program that will allow them to completely avoid the tax through their lifetime and into their estate. But if a client, to Rob's point, if they break the exchange, just like a 1031, just like a 1035, then there could be a capital gains liability. But generally it's not. We set it to be the whole, get rid of the whole thing.
And most investment firms have resources. So what you do is you then use the assets that are in the 1042 exchange, and then you go get, you borrow money at a substantially reduced interest rate because the loan's fully collateralized from a brokerage firm or a bank, and then you can take those loan proceeds and diversify that into other investments that other than U.S. stocks and U.S. bonds. And there are programs that are specifically set up, like AAM. If AAM is your bond desk, they have a program specifically to deal with 1042 exchanges. So we're at the top of the hour. We're 1 minute over. If you have questions or comments, feel free to call us, C.O.R.E. Call your relationship manager. Our number here is 480-991-4072. You can ask for myself. You can ask for the case design team. And if you have a relationship manager, feel free to reach out to them. We greatly appreciate everybody participating today. This has been recorded and would be available. So anything we can provide in resources, please let us know. Thank you for joining us today, and we will close up. Thank you, Roy.
Have a great day, everyone. You bet. Thanks, Rob.